Good morning again. As I said, I am Bernard Jeter with Insurance Advisors Direct, and I'm the life and annuity manager. And what we've been doing for the month of January is talking about IULs. And then our series is on how to be an IUL expert. But you don't really have to be an expert, just have to have a working knowledge of IULs and the different concepts and purposes of them. And then Insurance Advisors Direct, myself, and our team will do the work for you. I mean, you just have to meet with your client, fill the app out, all that good stuff, but we'll be that whole back end support. So today's webinar is on long-term care and IULs. And folks, if you can, somebody raise their hand and let me see if you're able to see the presentation. All right, great. Thank you. So here, this presentation that you see before you, you can actually use with your clients in your presentation. So I'll go through it as if we're in a virtual seminar setting. All right, here. So let's get started. And with this presentation, it'll also have a script that you can use so you don't have to fumble around. And I may fumble around a little bit with it because I wrote it up this past week. Good morning, everyone. Thank you for joining us today. My goal today is to provide you with education on the potential options available to address long-term care expenses that may arise as you look towards retirement. Now, folks, here a little disclaimer. Please note that this presentation is only for educational purposes and not for the solicitation of any particular life or long-term care insurance product. Now, folks, when discussing long-term care, it's important to start with the basics and expand your knowledge from there. So today, we're going to begin by discussing what is meant by long-term care. Then we'll speak as to why the potential need for long-term care should be included as part of your retirement strategy. We'll touch on various options you may have available to you for care providers. And finally, we'll discuss some options to help address the cost of long-term care. Now, before we begin, I want to ask the group just a couple of quick questions. And if you would, I mean, you don't have to raise your hand or anything like this, but think of yourself as the client you are presenting to. So, and we can all relate to the questions about to ask. Who in here today has ever had a family member or a friend that needed long-term care? And I'll say I'm raising my hand, me. Who in here is currently a caregiver to someone receiving long-term care? That was me some years ago with my mom. Now, who in here has thought about potentially needing to be a caregiver to a spouse, relative, or friend? And then finally, who in here already has a written plan for long-term care should they need it? Now, what exactly is long-term care? In short, it's informal or formal assistance should you be unable to perform some of what is known as activities of daily living or ADLs. And we'll discuss what these ADLs are in an upcoming slide. Now, in regard to informal methods of care, they include family, friends, or members of the community, which can include church support, local charities, or organizations like Meals on Wheels. Now, formal methods include, but aren't limited to, assisted living facilities, nursing homes, qualified in-home care, such as homemaker services or skilled in-home nurses, and adult daycare. So how does a long-term care need get qualified as such? Well, generally, it's by looking at someone's ability to perform the activities of daily living. So what are the activities of daily living? In short, these are things we typically do every day, sometimes as soon as we get out of bed. We tend actually take these for granted, but most claims begin with the inability to perform two of these six ADLs. So if you woke up this morning, got out of bed, took a shower, you already performed two of these ADLs. But let's say you woke up and needed assistance getting out of bed, or in bathing yourself, or in dressing yourself. These are the kinds of things that we typically do every day that may become harder to do without assistance as we get older. Now, we may qualify, we can't qualify, well, we can't, when we can't perform two of these six functions, we may qualify for long-term care assistance. So why should long-term care needs as part of your retirement strategy? Well, there are a number of important reasons, but let me share with you just a few of them. Now, the U.S. Department of Health and Human Services states that someone turning 65 today has almost a 70% chance of needing some type of long-term care services and support in their remaining years. I mean, I can't speak for you, but I would guess that a majority of the people here today would want to live past the age of 65. So let's assume you're going to make it past age 65, and you unfortunately happen to be part of the near 70%. So based upon claims data from Genworth, who is one of the largest and most respected long-term care insurance providers in the industry, the average person is on claim for 4.3 years if that claim lasts longer than the first year. Now, however, long-term care isn't just for those that are physically impaired. Cognitive impairments are also considered, and the Alzheimer's Association states that after the age of 65, the average life expectancy of someone with Alzheimer's is 4 to 8 years. Yet, some folks live as long as 20 years with Alzheimer's and dementia. Now, these are just a few of a number of statistics that support discussing long-term care as part of your retirement strategy. So yes, long-term care may be needed when you can't perform two of the six ADLs, but there are other factors as well that may require permanent or even temporary long-term care need. Things like falls or accidents, chronic illnesses such as arthritis or back pain, stroke, or as we mentioned earlier, cognitive impairments. Now, planning for a potential long-term care need is like trying to drink from a firehouse. So there's a lot of information out there and it can become overwhelming very quickly. So here are a list of questions to help you begin the conversation. You should have not only within yourself, but potentially your loved ones as well. These questions include how your family and your retirement strategy can be affected by a long-term care need. Where should you consider receiving care should you need it? What the potential costs may be, and finally, your options in covering that cost. So let's address quickly the first question that you need to ask yourself. This is an important place to begin thinking about your plan for a potential long-term care need, because it will be the first thing your loved ones consider when helping you receive care. Now, first and foremost, you need to consider who will be providing for your care. Some will choose informal care, like friends and family that we discussed earlier. Now, however, that care may need to be formal from day one of that need. Now, if that is the case, who will oversee the process of beginning your care, such as choosing a facility or service? These are questions that are best addressed in advance rather than at the time of the need. Now, secondly, have you dedicated a potential portfolio asset insurance policy specifically to address the cost of long-term care? Now, if you have chosen to use an asset, there are things you need to discuss with your financial or tax professional. Now, is that asset potentially going to be used as a source for retirement income? How would that affect others who may rely on that income as well? Also, is that asset subject to taxation? If so, think of the net amount after taxes when determining if it's enough to fulfill the cost of your long-term care services. Now, remember, when I said about long-term care, it was like drinking from a firehouse. Well, that's because there are so many ifs in finding a solution for care. That's why it's so important to have a written plan just in the event of a long-term care need, because these ifs can determine what the potential cost of care could be. Now, for example, who is providing that care and where is it being provided? How long should you plan on receiving that care, and what will it potentially be needed for? All of these ifs will help guide you in figuring out your written strategy and picking a solution that achieves its goals. That's why it's so important, folks, to discuss a plan for long-term care with a licensed insurance professional, which is yourself. And part of putting together that plan is knowing the cost of care in your specific area, your access to those facilities. I mean, everyone is different, and so their individual solutions for care should be tailored to their perceived needs. And you, the professional, can help give that proper guidance to create a plan. And as we go through these, there's some of the cost folks will be looking at. So, and what are my options? So at this point, we covered what long-term care is and why should it be considered as part of your overall retirement strategy, and the potential costs associated with long-term care. Now we should be looking at the options available to you so that you can begin the process of making an informed choice when planning to address potential long-term care needs. Now, let's touch briefly on public programs. Many people see Medicare and Medicaid as a good way for the government to help offset the cost of long-term care. And they would be correct in that the government can certainly help. However, folks have to qualify to receive those benefits first, and not just in the sense of 2 of the 6 ADLs or activities of daily living. In some instances, may require you stay in the hospital first before it can help. Medicaid can also cover costs, but you may need to spend down other assets in order to qualify for Medicaid. I mean, coverage for both of these programs can also be limited in how much they'll cover for an individual on a daily basis. You should consult your health professional to discuss if either program is a fit for you. Now, secondly, let's talk about self-funding. And this is where, go off script on here, and this is where you all come into play with. So this is an area where a financial professional, such as yourself, can guide or provide guidance. They work with you to look at your portfolio and identify assets that may be used to offset costs. They can also help you determine if a particular asset may face outside risks such as market volatility, inflation, and being spent down for your own personal retirement. Now, if you feel like you've gotten a whole bunch of information, but it's not quite sunk in yet, trust me when I say that it's a common feeling. And folks, I mean, we've all sat with, our clients, and they can become overwhelmed with a lot of information that we provide them. But I'll say that, it is a common feeling. This is a lot of information, but our goal is to make it as simple as possible for you to absorb and understand. So we're going to briefly run over a few examples of the different ways in which you can cover costs of long-term care. First is how self-funding works. As you can see, we have our individual here, and unfortunately, this person is one of the 70% that requires long-term care. So, where we put those funds from to help cover the cost of it. Now, that's up to the individual. They use their savings, their money market accounts, their income streams from annuities or IRAs, or what about stocks, bonds, mutual funds, and other portfolio assets? Will they have to sell their second home or take out a reverse mortgage on their current home or downsize? Examples like these are precisely why it's so important to have your plan detailed out. This could be a situation where the person couldn't qualify for long-term care insurance or never attempted to purchase it before they needed long-term care. In either scenarios, the decision isn't just where they should receive care, but what assets they use in order to cover the costs. But I'll say that again, but what assets they use in order to cover the costs. Which do you use first? How do we protect our current and future income stream? Where do taxes fit into this scenario? I mean, these are all potential issues that need to be considered when self-funding. Now, continuing on, a lot of folks rely on informal care. Now, this type of long-term care is usually provided by known and trusted individual. This can include family, friends, and those within community, as we said earlier, church members or local charities. Now, when considering informal care, it's important to think of the availability of the informal care. When will they need and will they be available at those times? Also, how far is the caregiver from the caretaker? Do they have far to travel in order to provide assistance? And how will that affect the quality of care available? Now, finally, it's the toughest thing we will discuss today in informal care. It can carry a physical, financial, and/or emotional toll on the caregiver. You see this most when care is given by a close relative, such as a spouse, adult child, or other close family members or friends. No one wants to see a loved one have a long-term care need, but it does happen sometimes. It's important to consider whether or not the potential informal caregiver will be subject to any impact. And finally, there's the option to purchase insurance that is specifically tailored to address the needs surrounding long-term care. So let's discuss the last option of long-term care with coverage options a little more in depth. As we discuss, keep in mind that the way of long-term care claim is initiated is by being unable to perform 2 of the 6 activities of daily living certified by a medical professional. Now, first, we begin with traditional long-term care. Now, this type of insurance has been around for decades with the purpose of addressing a number of various needs and benefits regarding long-term care. Now, it's designed to reimburse the potential costs of formal care. Now, remember that formal care is care within a facility or by a skilled professional. Now, second, there's an option to purchase life insurance with an optional long-term care rider at an additional cost. And these products can also be referred to as hybrid products, in that the death benefit can be accelerated for formal or informal care as long as the individual qualifies for care. Now, with this strategy, if you qualify for life insurance, the death benefit may be accelerated for long-term care services once you qualify for care. Now, folks, depending on the product purchase, you may be able to receive long-term care benefit for formal or informal care. Another potential benefit is that the premiums may be more flexible to better suit your individual budget or guaranteed never to rise. And lastly, we have linked benefits. Now, these are similar to life insurance with long-term care riders, but the overall long-term care is usually larger than the death benefit. And another thing is to consider is that the premiums and benefits are guaranteed, and premiums may be paid at once over the course of 5 to 10 years. One of the most popular features of these products are most of them offer return of premium options. Now, generally at an additional cost, so that if you change your mind or need the premium back, you have the potential to receive all or a portion of the premiums back from the carrier, subject to, of course, terms and conditions of the particular insurance carrier and product. Now, let's move on to an example of how long-term care works. And this scenario is pretty cut and dry. All right, individual unfortunately requires long-term care, and there's a bucket of long-term care money which they can pull from. And these benefits will help offset the cost of care. Now, the individual considerations here include how long they're paying for this insurance and whether or not these premiums could increase in the future. Is it possible that the benefits of long-term care policy could be decreased by the carrier in the future as well? What happens if the individual passes away and never uses the benefits? So there's no death benefit. So there's no death benefit of which to speak. So what happened to all of the premium paid in overtime? The long short of it is that traditional long-term care is a functioning option, but it's limited to helping with only long-term care. Now, additionally, because carriers are forced to raise premiums due to rising healthcare costs, many clients opt to decrease benefits in the face of those rising premiums to maintain coverage amount. Now, we move into an example of how life insurance with an optional long-term care rider works. Now, in this scenario, the client has purchased a life insurance policy. The death benefit of that policy can be accelerated while the client is still living to cover the cost of long-term care. Now, as long as they are certified as having a long-term care need via the two activities of daily living to qualify. Now, sometimes this acceleration of the death benefit can be a reimbursable expense, or it can come as cash indemnity. Now, which can help in the event that the individual is receiving informal care. However, as you draw down on the long-term care benefit, it lowers the death benefit as well. Now, once the death benefit has been exhausted, there's no more long-term care benefit or a death benefit remaining, and the policy is considered paid out. Now, this scenario is beneficial to clients who want to receive a little more for the premium that they pay into a policy. The death benefit provides added protection for the client's beneficiaries in the event that the long-term care is not utilized, and offers some sort of benefit in each scenario as the client ages. They will either live long enough and utilize the long-term care benefit if they get sick, or they will pass away and the beneficiaries will will receive the death benefit. Now, in the event that only a portion of the death benefit is used for long-term care, the beneficiary would receive whatever the death benefit amount is remaining. as you can see here in the scenarios. So now, there we go. Now, in our final scenario, the product that, in my opinion, offers the most flexibility for a client that is at or near retirement is called a linked benefit or acceleration product. And these products offer three main options for clients. Very simply put, we call it live, pass, or quit option. Now, here's how they work. In the live option, the client will live long enough to use a long-term care benefit, which is a large bucket of money. Now, even larger than the death benefit offered. Now, sometimes this can be 4 to 6 times larger than the premium paid into the policy, and can even grow over time by using an inflation rider. Now, this allows the client to have a policy that could cover their long-term care needs for upwards around 6 years if necessary, and usually provides hundreds of thousands of dollars in potential long-term care benefits. Now, in the past option, the client passes away, lives without using the long-term care benefit or only a portion of it, and the remaining death benefit goes to the client's beneficiaries. Even in the event that the client uses all of the long-term care benefit, meaning the death benefit is exhausted as well, there is even a residual death benefit left over to help cover final expenses. And usually, folks, that's I don't want to give a minimum, but generally $10,000 to $20,000 left for as a residual death benefit. Now, in that option, in the quit option, it allows the client to be able to receive a portion of their entire premium paid into the policy. Now, in the event their needs change, changing needs could, include investments not performing as expected in retirement, income needs increasing, or some other unexpected event. Now, what these products do is give the client some sort of safety valve, and that allows them to recoup some or all of their premiums if absolutely necessary. Plus, an added benefit is that all the numbers provided in the product illustrations are guaranteed. Now, usually these are single premium products, but they do offer the flexibility to become paid in over time. Now, they tend to be a little bit more expensive than some of the other options available, but due to the return of premium option, it's important to look at these products as leverage vehicles. I mean, we're spending more now, but we can sometimes recoup those costs later. So in essence, we're not spending the money as much as leveraging it for a greater value right now. So, like I said earlier, you're going to be drinking from a firehouse today, and I think we shared with you a ton of great information for you to consider. So what are your next steps? It's quite simple. When your agent, think about written strategy. Talk with your loved ones and develop a plan for the type of care you envision just in case. Next, you will want to meet with your financial or licensed insurance professional, which is you all folks, to discuss your plan and get their guidance on solutions. Now, work with your professional to develop a plan for how to fund the care you've envisioned. And then there's solutions you'll want to consider, including a benefit amount, period length for your care, what type of care you want to receive, and then think about the risk of inflation or rising medical costs and how that can affect your care. Now, once you've laid out these considerations, work with your professional to talk about how creating a plan may help alleviate any potential financial impact to your current strategy. Well, folks, that is the presentation which you will have access to with Insurance Advisors Direct. I mean, our team here, let me stop this, and there we go, folks. So yeah, so you do have this presentation available to you to use with your clients, either in seminar setting, virtual seminar setting. Actually, we'll take it a step further. We will be glad to host a virtual seminar for you, actually with this presentation or with our tax diversification strategy presentation we did last week. I mean, all we ask is you get at least 5 clients, and we'll be glad to run this illustration for you. It won't be as choppy as it was today. It will be quite smooth for you, so to impress your clientele. We'll also have invitations for you. And I say we'll do it on our Zoom platform for you. So that'd be no worries at all there. So let me ask you this, folks, do you have any questions before we stop this webinar? And I will be calling each and every one of you today that attended this webinar just to talk about long-term care strategies and IULs to see how that may fit in your mix of things. So, folks, don't have any questions. We will see you next week with the perfect product pitch for IULs, and you all will actually enjoy that presentation. Ms. Fetters, yes, ma'am. We do have general information that I will be able to send you. And I'll send everybody some general information on long-term care hybrid plans and asset-based plans or linked benefits. Andrea, you are so welcome. So yeah, like I said, this presentation will be uploaded to our YouTube page, so you will it will be available to you. Folks, make sure you subscribe to our YouTube page. So go on YouTube, type in Insurance Advisors Direct, click on subscribe, and you will have a host of videos at your beck and call. Okay, great. Judy, I mean, we can talk offline. If I say I'll give you some information. Actually, I'll give you our long-term care quoting request form that you can fill out and send back to us, and we'll run those illustrations for you as well. Okay, folks. Well, that's it. Like I said, see you next week. We got one more question in. All right, great here. Let me copy and paste that. All right, folks. Like I said, see you next week, next Wednesday at 11 a.m. We'll have our good friend Chris Schieffer with us. He is a resident expert on the perfect product pitch. All right, take care, folks. Bye.